Hi, Southern Cross Austereo, MLC, Superannuation members. My name is Travis Bailey, Senior Financial Advisor from Advice First. And we're the servicing advisors for Southern Cross Austereo in relation to their superannuation and other financial planning needs. I'd like to thank you for joining us for this webinar today. In your invitation, there was also an opportunity for you to book a one-on-one appointment with us to discuss any of your personal matters. I'll take you through the presentation and I'll share my screen, which will just go through the agenda for today. And at the end of the presentation, if you've got any queries, please feel free to reach out to ourselves. So today's presentation is of a general nature, so it doesn't take into your own personal circumstances. Like I said, it's of a general nature. So if you would like to speak to us in relation to your personal matters, feel free to reach out at any time. Today's agenda, we'll talk about who are Advice First, get you thinking about retirement, whether you're on track with a comfortable retirement or not. I've got a live simulator that I'll share with you as well for you to be able to access, how to grow your super through concessional and non-concessional contributions, getting the most out of your superannuation. And if you'd like to learn more, we'll have obviously some details of how you can obviously reach out to us as well. So who are Advice First? We're a privately owned financial planning firm, and we've been providing financial advice, education and support to Southern Cross and its employees for over 16 years. We've specialised in advice and education for more than 41 years. We are local, we are Gold Coast based, and we service private clients, commercial, corporate, and they are both nationally and international clients as well. We have 9 qualified practitioners, also known as advisors, who specialise in specific areas of advice, and they're supported by our incredible administration team. We also provide objective advice, and we're proud to say that we've got about a 95% retention rate of private clients. So we take this absolutely serious and would love to be able to connect with you further if you ever have any queries. So thinking about retirement, the main thing that comes to mind is how much is enough for retirement, and it is something that we get asked all the time. So I guess when it comes to the retirement, the amount of money that you actually need to accumulate depends on how you want to live, what your lifestyle looks like, how long you will live. Obviously, there's a huge shift in our demographics these days that we are living longer, so we need to take that into account. So that obviously has a huge impact as to how much how much savings you need accumulated to support your retirement, and also importantly where you live. Obviously, that will obviously reflect on your lifestyle and how much you obviously how much your expenditure would be on an annual basis. So I wanted to just run you through a retirement forecaster. Down the very bottom here, MLC have provided a terrific interactive projection tool, which is a calculator to help you project exactly how much you will accumulate in your retirement. So I'm just going to share my screen here. And I'll take you through the landing page. So when you go to obviously to your browser, type in www.mlc.com.au/personal/retirement/am I on track. And it'll take you to this landing page. And what it is, it's a retirement forecaster. When you scroll down, it'll welcome you. It'll have a tab about you and also your superannuation. And what this is this forecaster, it's designed to give you an estimate of how much super you may have in retirement and how long your super will last for, and roughly what sort of income it will go ahead and provide you in retirement. So all you do is you tick the terms and acceptance box here, and you can also click on some disclaimers and assumptions here as well, which gives you some background information in relation to some of the calculations of today's simulation. You've also got some edit assumptions here as well, so you can change whether you want to include the age pension in your calculation, wage inflation, price inflation, insurance premiums, and also what sort of investor you are as well, depending on your risk profile. But we won't touch them for now. So what we do is we tick the terms there and continue. So it'll take you to this landing page where it will ask you your gender. So for myself, we'll put in male. Also your income. So you can use this scale here. Let's put an income of, say, $75,000. Your age, let me put myself in at the age of 39. And also my current balance within my super, let's say I've accumulated 200,000 in super, and simply click continue. So a couple of assumptions here. It'll provide you here with your balance and also your income. So let's click on balance to start off with. And then on the right-hand side, it'll look at what your target income is in retirement. So I'm saying I'm earning $75,000 per year at the moment. Let's say in retirement, let's say I'm going to require $55,000 per year in retirement. My retirement age, it defaults at age 67, which is the age pension age. Let me put that back to, say, age 65. Now it's got here, please tell us about additional contributions into super. So as we know, superannuation is a tool that over time it's invested. You have your employer contributions being contributed, which is 10% of your gross salary. But then it also asks, are you making any further additional contributions? So you can make additional contributions via salary sacrifice, which are before tax contributions, which is here. And you've also got after tax contributions, which is here, which you can also include. So let's just leave that as is for now, and then we can incorporate some contributions after the calculations been completed. Down the bottom, you've also got your investment mix. So your superannuation is invested over your lifetime to go ahead and earn a rate of investment, depending on the amount of risk that you take within your investment portfolio. So this defaults to a moderate investor, which is saying you have around about probably 50% of your money is in shares and property, and the other 50% of your superannuation is in cash or bonds. But let's say we move up in the scheme of things when it comes to our more exposure to risky assets such as shares and property. Let's make ourselves a growth investor. Now, a growth investor has around about 85 to 90% of your money exposed to shares and property, and then around about 10% of your money exposed to defensive assets such as cash and bonds. So for this calculation, we'll place ourselves in as a growth investor. It also provides you the opportunity to work part-time through your retirement. How many days per week? You can adjust that from what age you'd like to be working part-time. It might be after you retire, and also for what period of time as well. But for now, we'll just leave it as I'm going to be retiring at age 65. It also incorporates the age pension of whether you will be eligible to receive any subsidy from the government from when you get to age pension age, which is age 67. Look, your age pension is worked out based on what assets you have and what income you have at the time of applying for age pension. So let's just say that I've accumulated, not including my house, let's say $240,000 worth of assets, and let's just say that I'm single for this calculation. Any income? No. Look, I'm not going to be earning any further income once I retire. This calculation also has the space for you to be able to include your spouse as well, but at this stage we'll just keep it to myself. So look, it says based on my income, based on the risk profile of being a growth investor, and that I'm going to retire at age 65 on an income of $55,000 per year, it says that I'm going to accumulate around about $430,000 in my super. And it says, and it projects here that it will probably run out at age 78. And remembering my life expectancy for a male of my age is around about 84 years of age. So look, if you click on income as well, what it is it shows you the income that I would receive. So from my super at age 65, I'd receive $55,000 directly from my super, which when I do retire, it converts to pension phase. So I'm drawing on my super for 2 years. And then remember at age 67, that's when I'm eligible for the age pension. So you can see here, age pension, I'd receive around about close to $14,000 per year. And that would then be subsidised by money drawing out of my superannuation or my pension of $41,000, which provides me with my target income of $55,000. Now it shows me here that my superannuation in dark orange is going to run out at around about age 76. And then when I get to age 77, I'll be solely just drawing on the age pension. So I'm only going to be able to reach my income needs up until age 76. And then I'll be earning around about $25,000 per year from the age pension. Now, one thing that can improve this scenario is if I make any additional contributions. So for tax purposes, look, it is tax effective. If you're earning around about more than, say, $56,000 per year, it might be a tax benefit for you to be salary sacrificing into super. So that's a before tax contribution. Let's say I'm going to put in an extra, let's say around about $2,900 per year. You can see here what impact that has to my superannuation savings. It's now pushed me out to nearly $500,000 worth of savings. And you can see here that it's pushed out the longevity of my super through to age 79 when it was previously age 76. So look, quite a compelling illustration. And you can see here as well, when you look at the income, just what impact those salary sacrifice contributions have on my superannuation savings. So look, I'll leave that with you. Have a play around with that. As I said, the website is available through the MLC site, and yes, it's quite a interactive site for us to calculate roughly how much we're going to have in retirement and what sort of income you're going to derive as well. So once again, there's the website for your use. So moving forward, will my super be enough? So we just had a look just to see, look, really just with my contributions from my employer, with my investment earnings, with extra contributions, with the help with the age pension, is that going to be enough? So these are things that we need to ask ourselves. Are my employer superannuation contributions enough to meet my retirement goals? What are the options to grow my super, which I'll share a little bit more with you later in the presentation? Will the age pension and my current super be enough to support how I want to live and where I want to live? And how can I get further advice if I need it? Or you can simply contact ourselves to talk about this in more detail. When we talk about a comfortable retirement, so there's research by the Association of Superannuation Funds of Australia, and it shows that for a comfortable retirement, single people may require a lump sum of $545,000, and couples may require a lump sum of about $640,000. So this is based on the average budget and living standards for those around the age of 65. And it also assumes that to live comfortably, a single person would spend around about $44,400 per year. You could see I calculated $55,000, which is incorporating a nice holiday overseas per year. And couples, they would spend on average around about $62,800 per year, maybe add an extra $5,000, $10,000, $15,000 for those more extravagant holidays in your retirement as well. There's also some calculators online that are there to help you with calculating roughly what you would be spending in retirement as well. So you can go online and search for what ASFA retirement standards look like, and there's a calculator available which will help you work out roughly how much you're going to be spending in retirement. Let's remember that retirement age. Let's look back at 1909. If we go back to 1909, an age pension age for a male, the age pension age was age 65, and about half the male population only lived to the age of 65, only half. And then when you hit retirement, the average time spent in retirement was 11 years. If we fast forward now, say 113 years, now the life expectancy of the average male is age 80. That's a big difference from age 65. And the average time spent in retirement is now close to 20 years. And even females, they're expected to live a little bit longer than males, with the average life expectancy for a female around about age 84, 85. So look, people are living longer, which means that are we requiring to draw on more superannuation savings to go ahead and provide for our retirement. So how do we contribute to our superannuation? Well, firstly, we look at where we invest our money. That's the important thing. Now, I spoke earlier about our tolerance towards risk. And whenever you invest your money in your super, your money is invested into a portfolio, which is managed by the likes of MLC, or regardless of who your super is, your superannuation provider would have underlying fund managers and investment managers sourcing investment portfolios, putting them together for them to obviously earn the appropriate level of interest for you. Now, those portfolios are made up of different asset classes. So you've got high levels of return for high levels of risk. So if you look at the more defensive and less volatile and risky end of the spectrum, you'd invest your money in an asset class called cash. You can then step up and invest your money into fixed interest, or also known as bonds. Now, those two asset classes are called defensive asset classes. Then you start moving into more aggressive assets such as property, shares, infrastructure, which are things like investing in railroads, airports, gas, water, electricity, all of those utilities. But, you know, property, infrastructure and shares, look, they are called growth assets, and they make up a large proportion of people's portfolios because they do provide greater return over your lifetime, but with what comes with that is greater risk as well. So it's not uncommon to see a portfolio that's got a blend of both defensive and growth assets as well. So you can see here that in these model portfolios, you can see that you've got portfolios that are a blend of growth assets and also defensive assets. And ideally, they're there to work with your super throughout your time. So usually they start with a lot of exposure to growth assets, say when you're in your early 20s. That's in the dark blue there, and in the light blue you've got your exposure to defensive assets. So soon when you get to around about your mid 40s, you usually start to maybe de-risk with your portfolio. So when you get to say age 65, 66, 67, you may have about half of your investments invested in growth assets and half invested in defensive assets. So when we're contributing to super, we have concessional contributions. So concessional contributions, I did mention these earlier, that are things like salary sacrifice. So that is when you're directing some of your pre-tax income into super, which could boost your retirement savings. When you do that, you pay a contribution tax rate of 15% when your salary sacrifice contribution goes into super. So that means up to 85 cents in every dollar is at work for you in your super. That money is invested in the highly tax-effective super environment, and also earnings within your super, they're taxed at a maximum of 15%, where earnings outside of super are taxed at your marginal tax rate. So it's quite simple. If you're wanting to salary sacrifice, or whether it's beneficial for you or not, to give us a call, but also to speak to payroll, and they can set up a salary sacrifice super contribution arrangement for you. How do you start salary sacrifice? Calculate how much your superannuation guarantee contributions will add up to for the financial year. So your SG contribution, that stands for superannuation guarantee. That's your employer contribution. It's guaranteed that your employer must pay at least 10% of your gross income as a minimum into super. That's called your SG contribution. Whatever that equals, okay, calculate whatever 10% of your gross income is, and the amount you're allowed to salary sacrifice, it can't exceed $27,500. So just take $27,500, take away how much your employer is contributing, and there's the difference as to how much you're able to salary sacrifice. Think about how much you want to contribute from your future salary, your savings, your bonuses, or even when you get leave. You can go ahead and organise these arrangements as well. Speak to ourselves. We're a professional, we're advisors, and we're here to obviously obtain more of your information and understand your circumstances as to whether salary sacrificing would be suitable and beneficial for you. And then finally, you put in an agreement in place with your employer, put it in writing to go ahead and start making compulsory super guarantees. Making salary sacrifice contributions into your super. So if you look at a calculation, looking at say on the left-hand side, someone who's on a gross salary of $75,000. And they would normally pay around about 21.78% in tax, which is around about $16,342. So that would leave them with a take-home pay of $58,658. Now, if we look at the right-hand side, the scenario of salary sacrificing there, you've got someone on the same income, $75,000. They choose to take $70,000 as a salary, and then $5,000 they decide to write an agreement with their employer to sacrifice $5,000 into their super. Now, the tax on their salary of $75,000 is $14,617. So that tax rate has reduced slightly. And also the tax on the superannuation going into super there by salary sacrifice is taxed at 15%, which is $750. So the total tax paid for someone there is around about $15,367, which brings them down to a tax rate of around about 20.48%. So that's around about a 1.3% saving in tax. The thing here is that your take-home pay for this individual would be less slightly, of about $55,383. So you've foregone a few $1,000s, but the money that's been added into super is after tax there, $4,250. So the net benefit compared to someone who doesn't salary sacrifice is quite encouraging. It's around about $1,000 difference in tax saving that you have on making that contribution, that salary sacrifice contribution into super. You can also make non-concessional contributions into super. So that is an after-tax contribution. So with your contribution caps, I'll just remind you, when you're making a concessional contribution, it's $27,500, which is employee contributions plus salary sacrifice contributions, can't exceed $27,500. And then in any financial year, you're allowed to make an after-tax contribution into super also up to $110,000. So that's money that's in the bank account that you've already probably paid tax on. There's a thing called the carry and the bring forward rules as well. So from 2019, the carry forward rules came into effect, and that allowed you to make extra concessional contributions above the general concessional contribution cap without having to pay any additional tax. So what it allows you to do is that cap of $27,500, let's say in a year, your employer contributions plus your salary sacrifice contributions equal $20,000. It means you've still got $7,500 that you're able to carry forward to the next $27,500 concessional cap year. So you're allowed to make an even greater contribution of concessional contributions. So you're allowed to do that for your concessional contributions and also with your non-concessional contributions, the $110,000, you're allowed to go ahead and make a lump sum after-tax contribution into super of $330,000 in one hit, but then you can't make any further non-concessional contributions for the following 2 years because you've brought them forward. Looking at the fees for MLC members within the Southern Cross Austereo MLC fund, you've got their administration fees. If you're in the My Super default investment option, the administration fee is 0.26% per annum of your balance, plus a fixed fee rate of $1.50 per week. And also there's a government levy cost recovery of 0.01%. There's also an investment fee of around about 0.46%. And there's also an estimated indirect cost ratio fee of 0.28%. On any other investments outside of the My Super default investment portfolios, you pay 0.16% of your balance, and there's also a fixed fee of $1.50 per week, and also the investment fees and also the indirect cost ratio fees can vary there as well as listed. There's also insurances available for MLC members for when they first join. There's a default level of cover. So if you go ahead and join the fund within the first 90 days, you are eligible to receive life and total and permanent disability insurance. For executives of MLC, it's a formula based. So to work out your life cover or death cover and your TPD, which is your total and permanent disability, all you do is you work out whatever your salary is times 20% times how many years you have left until age 65. And you also, that would work out what your lump sum entitlement would be for your life insurance and total and permanent disability cover, up to a limit of $1.5 million. Any amounts over that, you would have to apply for those additional sums insured personally. For general staff of Southern Cross joining, your formula is 15% times your salary times years to age 65, once again with an automatic acceptance limit of $1.5 million. And for casual employees, there's an age rate scale, which depending on your age, will then go ahead and allocate an amount of death cover and total and permanent disability cover. That's at a cost of $1 per week. Executives and staff are also eligible for temporary salary continuance insurance. That's up to 75% of your monthly salary. So really, if you're sick or injured and unable to work, and your doctor prescribes that you're unable to work, and you aren't able to work for a waiting period of 90 days, the insurance company you'd submit a claim to the insurance company, and if successful, you'd be eligible to receive 75% of your gross income, and that's paid as a monthly entitlement. And it has a 2-year benefit period as well. And then after 2 years, let's hope that you're able to return back to work or source some form of work. Once again, there's an automatic acceptance limit of $14,000 per month. For incomes up and above that, you would have to go ahead and apply for the additional cover. When we're talking about insurances, it's important to talk about beneficiaries and nominating a death benefit nomination. So in the event of you to pass away, where does your superannuation land? And it's important that it's handed to the people that matter to you most. So we have a binding death nomination available within our superannuation. And who can you nominate? Well, you can nominate a beneficiary which under the Superannuation Industry Act, that can be a financial dependent, and a financial dependent being your spouse, including a de facto, or even in same-sex marriage as well, can be your children, can be a financial dependent, so someone who is financially dependent on you, a legal representative, or your estate. So if you don't have someone who's financially dependent on you, like a child, you would then go ahead and leave it to your legal representative, and that would then be left for your will that would be in place. Also, if you're in an independent relationship, you can leave them as a beneficiary as well. The types of nominations available, there's a binding nomination and there's lapsing and non-lapsing. And with a lapsing nomination, they usually lapse every 3 years. So we encourage people to have a non-lapsing nomination. And that means that if your circumstances do change, we do ask that you review your beneficiary nomination and have it changed accordingly, just so money doesn't end up in the wrong hands as well. So getting the most out of your superannuation, look, there are government co-contributions that are available. So if you earn less than $56,112 per year, the government may top up your super with up to $500 per year if you make your own personal after-tax contribution to super. So if you're making an after-tax contribution into super, and let's say you put in $1,000, you're earning well under $56,112, you may be entitled to a government co-contribution of $500. So that's a minimum contribution of about $20 per week. You've also got spouse contributions as well, a handy little tax offset. So if you earn less, you or your spouse earn less than $40,000 per year, your spouse may be eligible to receive a tax rebate by contributing to your superannuation. You can contribute up to, say, $3,000 per year as an after-tax contribution into your spouse's super as a spouse contribution. If they're earning under a certain threshold, you may receive up to $540 as a tax offset. So you can speak to us or also your accountant in relation to that as well. Now, if you're wanting to learn more, look, there are some great features for MLC members within the MLC Southern Cross Austereo Super Fund. Best doctors, look, if you or a family member have an ailment and you're struggling for, I guess, a diagnosis or unsure of what ailment you do have, well, Best Doctors brings together 50,000 plus medical specialists around the world, and what they do is if there's any health issue that you may have, they're able to go ahead and write out to their network and provide them with any medical data to help them solve or provide some further diagnosis and medical assistance as to your ailment. So look, it's been around for many years, and also there's been a lot of success by just receiving and some peace of mind by just receiving that second opinion to receive obviously this specialised advice. So it is specific and exclusive to MLC members and to their families as well. Also, there's the MLC benefits program. It's like if you're wanting to receive cheap flowers or go online and purchase some movie tickets or any social entertainment lifestyle needs. The benefits program is available for MLC members. You log on to your MLC portal and you're able to access all the current discounts available across the platform there as well. With us with Advice First, look, we are also present and provide articles of valuable information on our social media platforms. So that's the likes of Facebook, there's Instagram and also LinkedIn. So they're our actual addresses there for each of those platforms. Log into the platforms, find us, follow us, and then pretty much on a daily or every second day, you will find that there's articles of information, and not just about superannuation, but anything financially specific that may be of interest for you or your loved ones as well. So finally, look, if you're wanting to contact ourselves, here are our details. I'm supported by the corporate superannuation team, which some of you may have spoken to Kim in the past. She's the Superannuation's administration manager. They're her details. Myself, there's also a QR code if you're wanting to book in a one-on-one meeting with us. We've also got Lisa Forbes. She's the partner of our business. She's also the home loan specialist broker. So if you do have a home loan and you're wanting to have a review of that, or just a bit of a home loan check, feel free. It's an obligation-free service available for SCA employees as well. And then also anything in relation to MLC, give Kim a call, but also you can also go direct to MLC as well. So look, that concludes today's presentation. Thank you once again for your attendance. If you have any questions or queries, feel free to reach out. In the invitation for this webinar, there is the opportunity for you to book in a one-on-one, so please reach out to us, book in a one-on-one, and we'll be able to help you with any financial needs or anything in relation to your superannuation. So to you and your families, from our family, take care and God bless.